It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. All right, back with more Managing Your Financial Future. I hear the theme song playing. That means it's time for us to talk, Professor Rick Plum.
And just not talk over the music.
That's right. Well, we could. I was trying to commission somebody to do an actual, write a theme song for us, because
a jingle type theme song.
Yes, just somebody who, years ago when we had our radio show, remember we actually had a jingle. We commissioned da 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 da. Remember that one?
No, I don't.
Oh well, this goes way
20,
back.
30 years ago.
Well, it was probably 20 years ago, back when they had jingles. Anyway, that was fun. It made us feel important. I have a musician friend who said, hey, I could write something. So I asked him like 6 months ago. I haven't heard anything. But if I can get that and in our own music, that's how you know you've really made it.
No, how you know you really made it is when people pay you to do this fun stuff.
Well, I mean, I maybe pay extra. I don't know. We had a lot of response. By the way, I'm Johnny Dam, your podcast host. I'm not an advisor. Professor Rick Plum here is certified financial planner and CFP professional, however you say it. You are here. We had a lot of response to last week's discussion on taxes. Who would have thought?
What? What was he saying?
No, that people said this was really eye-opening. Last week, if you're listening in order, we talked about using the tax code to your advantage. Now, we've been talking, who would have thought talking about taxes would be that interesting? But it was. It was a good discussion, and I think it was, as I said, eye-opening to a lot of people. Apparently it was, because we got some response on that, quite a bit, actually.
Well, taxes are one of those areas that are very confusing, but people are intrigued by it at times because I have control over that.
Well, once you figure out things like standard deduction, there's not an official 0% bracket, but
there's
there
a portion that's zero.
Where for a married couple under age 65, the first almost $26,000 of income that you make from any source is wiped off.
Does not get taxed.
No tax. So that discussion and using the 0% tax bracket, for lack of a better term.
Well, I will say that's where people get confused. When I field a lot of questions, they say, well, I need to keep my income under 83.5, so I stay in the 12% tax bracket. I said, well, what income are you talking about? Well, my gross income, my IRA distributions, my pensions, I got to keep it under 83.5. No, you're talking about the tax bracket is based on taxable income.
Yes.
And you're talking about gross
income. Correct.
So you can actually have more like $112,000 of gross income and still stay in the 12% married couple, just 12% income tax bracket.
Well, now that you mention that, one of the people who had emailed us has been a longtime listener going back probably 20 years. And I know this person, very loyal listener, and it's great, kind of followed us around. Had said, you guys talked about, I don't have the email here in front of me, but they said you guys had talked one time on your show quite a while ago about how somebody can make $100,000 of income
and pay no income tax.
You can be a million. No, not
that one.
You could pay how somebody with $100,000 of income could pay no income tax on that, and they wanted you to go through that again.
And
if
it wasn't
you would.
Coming from a Roth IRA. We weren't, getting cheap.
Oh
that
no,
way.
No, it wasn't. Yeah. Well, if you take $100,000 out of a Roth IRA, it is
qualified distribution, you're zero tax,
tax free. No, how you could have $100,000? Can we go through that, because
Sure.
It was really fun, and it points out how you can use the tax brackets to your advantage potentially.
Well, and it also depends on where the income is coming from.
Absolutely.
Whether it's coming from an IRA, whether it's coming from capital assets, capital gains. If I sell a stock for $100,000 that has no gain in it because I paid $100,000 for it about a year ago and I lost all the gain in the last year, I just sold $100,000 at no gain. There's no tax on that because It's my 100. But what about stock that I may have bought, 20 years ago, 25 years? 10 years ago.
That hypothetically has a lot of gain.
I paid $15,000 for it 10 years ago, and now it's worth $100,000. There's like almost $85,000 worth of gain in this stock. Can I sell that? And what is my tax bracket going to be? Is it going to be in the 10% bracket, the 12% bracket? What's going on? Do I get to use the standard deduction? Well, the answer is yes on the standard deduction. You can use the standard deduction to offset capital gains. And then you have a very large, depending upon whether you're married or single, 0% capital gain. So if I have no other income.
Yeah, let's start this off. How can I get $100,000 of income and pay no income taxes on this?
I could take that stock, and I haven't done the math quite well enough, but let's say I have some money though. I'm retired and I've got a pension, or I've got Social Security. I've got $25,000 a year, $26,000 a year of pension.
Okay, so let's say you got a pension, and I'm not taking Social Security yet.
And so, do I still get some amount of money? Yeah, sure. I could sell that $100,000 stock that creates $85,000 worth of gain. And even with my pension of $25,000, I'm still not going to pay any capital gains tax or any ordinary income tax. The reality is that $25,000 is less than my standard deduction. And the first thing that we reduce with the standard deduction is ordinary income items. So the standard deduction goes against ordinary income items first: interest, qualified, non-qualified dividends, wages, Social Security taxability, IRA distributions, pension money, things like that.
So if I have a pension, I'm getting $25,000 a year.
I can actually get a little bit more, but yeah, a married couple.
Yeah, married couple. So $25,000. That standard deduction under current law
wipes it out.
Wipes out,
and that's for somebody
the taxes.
It wipes out the taxes on that first 20. Actually, just shy of 26,000, but we'll just use 25 for nice round numbers. And then the next income that I'm going to show on my tax return is a long-term capital gain, because I'm going to sell that stock that I've owned for 10 or 15 years. And even though it creates $85,000 worth of capital gain
in this example,
in this hypothetical made-up example, it goes on my tax return. And as long as my long-term capital gain stays under certain thresholds, and with the math I just did, I stayed just under the threshold, I have a 0% long-term capital gain bracket. So I don't have to pay taxes on my pension, and I don't have to pay taxes on my long-term capital gains.
Which gave me how much in income?
Well, I just sold a stock for $100,000, and I had my pension for $25,000. So I had $125,000 of cash I can do whatever I want with right then. And I didn't pay any taxes. I had a huge capital gain. I still didn't pay any taxes.
So you had in this example, you had $125,000 of income for a year, and you paid absolutely no income taxes on that. And by the way, that's pension income and capital gains. This is not Roth. This is
what would technically be on the tax return.
Mm-hmm.
Roth doesn't show up in the taxable column, but the capital gains show up in the taxable column. Yeah. Pension income shows up in the taxable column. The first 25 and change gets almost 26,000 gets reduced because of the standard deduction, and then we get a nice big block of up to a certain threshold of total income. If it's capital gain, long-term capital gain, I don't pay any tax on it. So that's where some confusion comes in too. Long-term capital gain has the potential of a 0% capital gain. Now, that's not an unlimited amount. And so if instead of $25,000 of pension, I had, $55,000 of pension, well, then I can't take another $85,000 on top of that.
No.
So I've only got, another X amount of dollars worth of room in the 0% long-term capital gain bracket. And if I go over that, the next dollar of long-term capital gain is in another bracket.
So if I'm it's up to basically the end of the 12%.
They're not exact, but they're very close.
Let's just say they are. If I had income that takes me through the end of the upper end of the 12% tax bracket, ordinary income tax bracket.
Yes.
Anything beyond that, no matter how much capital gain I have, it's going to be taxable.
The capital gain comes on top of the ordinary income.
Right. So theoretically, Professor Plum, I could, if I had no other income, I could sell up to what? 83.
Well, it depends on what other income you have. If you have zero
Let's
other
say
income,
I have no other income.
you can probably go up to about $112,000 or so of long-term capital gain. If the only thing you have on your tax return is long-term capital gain, you're a married couple. This is married couple.
Yes.
You can probably have 112, 113,000 of total capital gain. The first 26 or so is wiped out by the standard deduction. That brings you down to the 83,000, give or take. And the first $83,000, if that's your only income, that's actually over and above the standard deduction, is a 0% long-term capital gain bracket.
What an interesting notion that is.
Now, we've seen people do this with something called NUA, net unrealized appreciation from a 401k distribution, where you can take employer stock, company stock, out of your 401k. There are some rules. I'm going to gloss over those. But let's say you had, a couple $100,000 of your employer stock in your 401k. You've been there forever. And when you take the stock, instead of rolling it to an IRA when you retire and you terminate employment and you roll if you roll your 401k over, you take the stock directly into your personal account. I take $200,000 worth of stock into my personal account, but I don't pay tax.
Is this company stock you're talking about?
This is company employer stock.
Highly appreciated.
Yeah, it only works if it's highly appreciated.
Yes.
Because I do have to pay tax on the value of the stock when it went into the plan. So if the stock went into the plan, back in the 80s and 90s, and it was worth, $4 or $5 a share then, and now it's worth, $100 a share over the years. So I can take it out not based on today's value, but I take it out based on what they call a basis, the plan's basis in the stock. So maybe I take out $200,000 worth of stock, and the value at the time it went in was $25,000. I'm just making these numbers up. I've seen them even better than that.
Okay.
I've seen them worse than that too. And so I pay tax on $25,000. Now I got $200,000 worth of stock, but if I sell that stock, it's going to be a long-term capital gain. Well, for the first 2 years of retirement, 3 years worth of retirement, I could sell that stock over a series of years, pay, show $83,000, no other income, or $100,000 of gain, and not pay any tax.
Yeah. So
now you're playing a risky game with that
because of the value.
That stock could go up or down in value.
Yes. Don't do this without professional help. But if it works out, it could be.
Yeah.
Yeah. We talked last week about don't waste
good.
Don't waste capital.
Low
brackets. Don't waste a 0% bracket if you possibly can. And not only do we have a quote unquote 0% tax bracket for everybody, married couples, it's up to about $26,000 if you're under age 60. But you also got this capital gains tax, currently 0% tax bracket.
And we don't see it often, but last year we did see some individuals who, for whatever reason, had a low income, whether it was pandemic related or otherwise, or maybe they just retired and were living on personal money and things. And they figured this stock, I've got room. And some people are have this much forethought. They sold long-term capital gain assets. They sold a stock that they really liked, that they've held for a long term. And they showed the tax. So let's say they sold that $100,000 worth of stock that had $85,000 worth of gain. And then they bought it right back. But they paid, so they showed that $83,000 again on their tax return, paid no tax on it because their income was like we said earlier. But now going forward, if it were to appreciate again, please, would the market go up a little bit? Any new appreciation will be taxed only from the new purchase price.
Sure, because they sold it and bought it.
Yes. And there's no 30-day rule on selling a stock at a gain.
No,
there is a watch sale if you try to do that on the loss side, but not on the gain side. Yeah. You can sell it and buy it right back, and you create the gain, and basically you're resetting your basis for the future. So some people will, instead of doing Roth conversions, maybe they don't have those assets available. They do it with their capital gain assets.
So that's just another trick that you can use.
Now, it may not have worked too well for them because they paid. Well, it could have worked because let's say they didn't pay any tax. They bought that stock for $100,000 back, and now it's worth $80,000. Well, they could sell it now
at a loss.
Wait 31 days to buy it back, and now take a loss. But unfortunately, you can only use $3,000 a year of losses.
Well, no,
unless you have gains.
Unless you have gains, in which case now we get into tax loss harvesting. I mean, my gosh,
this is tax gain harvesting.
This is gain. That is true. You can work it that way. I just
there's all kinds of little plays.
I know we talked all last week about this, but we had that question from the listener. who said, "Can you explain?" So there is a way to potentially have, what did you say, almost 125,000?
112 if I
112. Okay, 112,000 of income from non-Roth sources, sources which are normally taxable, and wind up paying no taxes on them.
For married couple under 65, it's 109,250.
Okay, but either way,
Over 65 was the 112 number I was thinking
so
of.
so whoever had sent that in, I won't give their name, but
you know who you are, Bill.
That.
No,
Thank you
no
for
idea.
asking that. That question. We haven't done that for a while, and I always enjoy talking about that. So, okay, now that you know how to potentially, again, manipulate the
your
tax
income, well, to maximize your efficiency on your tax brackets.
You can do that, and this is what good planning does. This was a question that we also got in. The markets have been down. The markets have been down pretty much all of 2022, at least we'll say year to date.
It's going to take a big recovery not to be.
Well, it's will. And this is just what happens, okay? This is what you get. The question was, with markets down, is this a good time to do Roth conversions? You just mentioned Roth conversions. I mean, if I had a stock that was on January 1 worth, $50,000 or something in my IRA, let's say.
Now it's worth a little under 40.
And now let's say it's 40 or 35, whatever it is. Would this be a good time to potentially do a Roth conversion?
Well, I think that if you have the room in the tax bracket, it was going to be potentially a good time to do it. This just allows you to convert more shares at the same taxable dollar than you could before.
Yeah.
So if you really believe that this is a temporary, like downturns are temporary, could be several years. When you're looking at doing Roth conversions, you're looking for converting, in cases, the asset that you feel is going to appreciate the best over the next 5 to 10 years.
You hope.
And so you're looking at, well, the S&P is at one point was down 24%, and that means it's 24% on sale. I can convert, 24% more than I was going to convert or thinking about converting before.
Yeah.
That's a good thing. If you were but just because the market's down doesn't mean that it's a great time to convert, because if you're in a really high tax bracket this year and conversions weren't going to make sense, I don't think the market being down 24% is going to say, well, I'm willing to pay, 35% on this, when I get to retirement, I'm only going to be in the 22% bracket.
Yeah.
So
what you're saying is, what you got to look at first is,
it's a nice frosting on the conversion cake.
If you looked and you said before doing a Roth conversion would make sense, and you were going to do it anyway,
or if you were on the fence of, wow, is it really going to help me that much? This could be what pushes you over the fence. But if you were nowhere near the fence, this is not enough, in my opinion, to put you over the fence.
Well, yeah, it comes down to how much you're going to be paying in taxes now versus.
Yeah, but hopefully, if I was thinking about doing it before when the markets were higher, I'm thinking harder about doing it, because the idea is I can convert more units. And so I have a better recovery potential. I have a better upside. It's weird because I think I have a better upside potential now than I did a year ago, obviously, because the market's way off.
Sure.
Now, that doesn't mean picking individual stocks that's going to work. But pick a good one.
Well, you can't tell.
But yeah, no, I think if you were considering it, this just makes it.
People, you talked again last week. We had so much information last week, and it was great. We talked about doing Roth conversions before you turn age 72, which is your
required minimum distribution age.
Minimum distribution.
Now, that
age.
doesn't mean you can't do required minimum distribution. You can't do Roth conversions after. You just can't convert the RMD.
Yes.
But if I was in a position where I could convert and stay in the 12 bracket or the whatever bracket I was trying to stay in, and I could convert, $100,000, because it was going to make sense for everybody, especially my surviving spouse or heirs, for me to do this. There's no reason. And let's say my RMD was 40,000. Well, that means I could take my RMD 40,000, put it in the bank, do whatever I want with it, and then take another 60 and convert it. Just because you got to required minimum distribution age doesn't mean you can't convert.
Or that it doesn't make sense to convert?
Doesn't necessarily. None of those go, lockstep. It means you can't convert as much because the amount equal to the RMD cannot be converted. It has to stay out. But if, like I said, if I was converting 10 a year and my RMD's 4, I still got some room for conversions. I'm still going to show that full 10, but only 6 of it in that example can be converted. The other 4 has to stay out. So it still can work. It's just a matter of knowing where you're at and why you're doing it.
Is the biggest factor in deciding whether to do a Roth conversion, is it your current tax bracket now versus your potential tax bracket later?
And that's a great starting point. It's also where you're going to get the money to pay the taxes from. Yeah.
Well, I suppose you could, take extra and
or convert less.
If
I've got, like I said, if I got $10,000 worth of room, and my tax bracket is, the 12% bracket, I convert 8,800 and take a $1,200 distribution. I've got my $10,000 of taxable event, 1,200 to pay the taxes on the 10. 8,800 made it over to the Roth.
Explain for people who aren't sure why Roth money is such a tax. Why having money in a Roth is so good from a tax standpoint.
Well, it's tax free, but it also does not affect your Social Security tax. So let's say that I've got my Social Security and I'm taking I've got some money in my IRA, or I'm taking, and so I'm going to take $10,000 out of my IRA, and I'm in the 12% tax bracket. Now, I've got plenty of room in the 12% tax bracket. So I take $10,000 out of my IRA to spend or whatever the case may be, and I figure, well, I'm going to owe 12%, $1,200. When I calculate my taxes, I owe $2,000. Well, there isn't even a 20% tax bracket. How did my taxes go up by 20% when I'm in the 12% tax bracket? Well, because at that level, not only am I paying tax on the $10,000 that I took out of my IRA, but I'm paying tax on $8,500 of Social Security that previously was not taxable. So I'm paying 12% on $18,500. I'm not just paying 12% on the $10,000 I took out of the IRA. So it's dramatically affecting my tax. So if I could have converted or contributed to that IRA before, when I was in a true 12% bracket, but instead of going to the traditional IRA, I went to a Roth IRA. Now when I take that $10,000 out of my Roth IRA, not only is it not taxed, but that Social Security that might have been taxed with a traditional IRA distribution isn't taxable either. So I saved a big chunk of money there.
So the Roth, does it ever show up on it? Is there ever a case where Roth money will hurt you from a tax standpoint?
Contributing.
Okay, distributing money from the Roth.
No, because it doesn't affect IRMA on the top side for the higher income earners. It doesn't affect the taxability of Social Security, and I probably should be quiet about that. Maybe Congress is listening, and they'll say, "Wait a minute, that's right. Let's find a way to, let's change that calculation."
Yeah, yeah, great.
Sorry, guys,
we're just kidding. You can't really
don't do that, Congress.
No.
But no, it doesn't show up in the taxability of Social Security. It doesn't show up in the taxability. It doesn't affect your adjusted gross income for any of the other things. It doesn't. Certain deductions have to exceed a certain level of your adjusted gross income. The only place that I just thought of was if you're trying to give very large charitable donations and get a deduction for it, because charitable donations are based, the amount that you can deduct is based on your AGI, your adjusted gross income. And while last year we had a big number, it's been scaled back this year unless they extend it again, which I don't think they will. You can't, if I have $100,000 of income, adjusted gross income, my Social Security, my pensions and all that, I can't make a deduction of $100,000. I want to give my university, my church, my, whatever, $100,000. I can't deduct it all. I can only deduct 60% of it right now.
If you're itemizing.
Obviously for my itemizing. And so, or if I take another $50,000 out of my Roth, it doesn't help. But this is the only thing I can think of. This is a stretch, big time stretch. But I cannot think of a place where having a Roth IRA, once it's already in place, and I've already done the taxation to get it there.
Well, it really is. From a tax standpoint, no matter what. You said before that you've known people with very large Roth IRAs.
Yes.
Where they're only living off, they're taking $100,000 of income all from the Roth IRA, and they have no income to show on their tax return, right?
I know some people that are taking more than that. They're living very nicely, $10, $12, $15,000 a month, all coming from Roth IRA and Social Security, and they ain't paying a dime in taxes. Now they paid some to get it there, and they did some great investing.
Well, sure, no, but maybe they did, or maybe they got lucky, and their Roth IRA.
Roth IRA grew very well. It helped.
Yeah, it can help. So having that money in the Roth, really, there.
I can't, other than the pain of getting it there. Once it's there, it helps.
Now you said the pain of getting it there, meaning because when
you either have to convert money and pay tax on it,
ordinary income tax,
or you have to contribute to it without a deduction.
And that's what happens. And we had one more question on that toward the end of the program last week. Boy, we got some mail on last week's show, as I said. Toward the end of the program, you were talking about somebody that had a daughter, and they were trying to decide. I think it was whether she should put money in
401k Roth or 401k traditional.
Right. And this speaks to Roth IRA or traditional, however it works. When do you decide if it's better to contribute to a Roth or which isn't going to give you a tax break now?
Right. But gives you tax-free later.
Tax-free later, potentially, once you've satisfied all the requirements. Or take a deduction now and contribute money into, say, a 401k, or if you can,
in this case, it was going to a 401k either way.
Yeah.
It's just that there was a 401k Roth, which you do not get a tax deduction for, but grows tax deferred and ultimately can potentially be tax free.
Right.
Or do you do the traditional route where you get the current tax deduction, it grows tax deferred, and then when it comes out, it's taxable.
This could be a dilemma, I think, for some people who are kind of on the edge one way or the other. Do they do Roth? Do they take the tax break now, or do they do the Roth side and pay the taxes now? How do you really decide?
Well, it's not the easiest thing, because a lot of people really like the tax deduction today. They like the ability to lessen their current pain.
Yeah.
Especially somebody who's making a lot of, all of a sudden went from making X to making almost twice X, and their taxes have gone up, and they've noticed it. I thought I was going to make, but my paycheck sure didn't double.
No kidding.
So they're looking for ways to potentially help that out. Now, there are some general guidelines. I don't want to say rules, but the younger you are, especially if you're at the beginning of your career, where you may not be making as much money now as you will be later, the Roth, I think, is a great thing. The younger you are in general, the Roth, because not that it's bad for older individuals, it's just that the younger person has a lot more time for that to compound and grow into a nest egg. Just like the traditional 401k has a lot more time and grow into a nest egg that's going to be taxable. So I think that and that's why, even though in this individual, they kind of like the idea of the tax deduction, I was trying to kind of nudge towards the Roth more, and they ended up going 50-50 on it.
Right.
But that doesn't mean that it's always better I know some people that are making tons of money in their early ages, but they know that it's not going to last forever. And so they don't want it to last forever. They want to work hard, put in the money. They're making
retire later?
Cut back later. They want to work like crazy from 25 to 35, 45, and save and build up, and then cut back their income and their hours when they're a little bit older. Basically, that was just some of their plans.
Wow, I never thought of that. Didn't occur to me.
Yeah, because we weren't making the big bucks at 25.
I was just having fun.
Right. But some people, the one person I'm thinking of, they got into a niche where they weren't expecting to be able to do this. I mean, they're in their almost 30-ish, and they're making big bucks. And they're saying, I'm going to ride this gravy train. I know it's not going to last forever. I'm not going to want to work this hard forever, but I'm going to try to build up and save everything I can right now when I've got extra, so that later I don't have to maybe work as hard.
Well, that's some good forward thinking, because usually when you're young and you're making it, you're spending it just as quickly as it comes in.
For this particular individual, they're working, and this gravy train requires a lot of time. Yeah. So they don't have the time to spend it right now anyway.
So they know that it's not going to last somehow, or it's just
niche
because
it's just they say, well, first off, I don't think I can last that long working at this pace.
Right. Okay.
I'm young enough now that I can do it. That's what they're saying, not me.
No, sure, yeah.
Because I'm not that young.
No.
But so it's all a matter of where are we at? Yes. What what is the cost of doing business today? It's costing us a tax deduction to put it into the Roth. We're not going to get that tax deduction. But looking at the downside or down future, what's it going to cost in the future for me to take it out? Sometimes that's really hard to look that far in the future, especially when you're young, to say that 40 years from now, I'm going to have to pay taxes on this money. I'm getting a tax break now. Who cares?
That's 40 years from now.
Yeah.
That's future me. Let them worry about that.
Old is 40, and you're talking about 65?
Forget
Give
about it.
Give me a break.
Well, that's the other mental side of this that
a lot of this is mental. As we get older, so people that are in their 45, 50, now it's an easier decision because we can get a look and it's a closer time horizon.
Yeah.
If we're 50, we're talking 10, 15 years from retirement. We have a better idea of what the taxes are going to look like. We have a better idea of how big the portfolio may be. We have a better idea of what is it costing us today versus what is this costing in the future. And so that's an easier one. Okay, it's costing you 33% combined between federal and state. The taxes work. And when you retire, you're going to be in a X bracket. So you're going to be either better off doing it this way or worse off doing it this way. That was a much easier one. And we typically don't have quite the same emotional role, but it still happens. But
well, you've also got, when you're trying to decide, not everybody has a Roth 401k option. So in many instances, they have a 401k option, or they say, well, maybe I'll put money into the Roth. The Roth, of course, is an IRA, and you are limited. Is it still $6,000?
Yes.
If you're under age 50, and $7,000?
Yep.
50 or older. 401ks, on the other hand,
you can sock a lot more money away.
Yeah, if you're under age 50, it was 19.5. Is it 20 now?
Yeah.
For 2022, 20,000?
20,000.
And we are up to 27. 27. Okay.
For 50 and older. And I had this question. Somebody asked me, well, I don't turn 50 until December 13th
Toward
or 15th.
Toward the end of the year.
How do I get the extra $7,000 in on that last paycheck? It's not a matter of that. You don't have to wait till the day. There are a few, but this is not one of them that is based on the day you turn 50.
So you could start putting it away the year you turn age
January
50.
of the year you reach 50, regardless of when you reach 50 during that year, whether it's January 2nd or December 31st, that you are now, in the eyes of the IRS, a 50-year-old for that limit.
Yes. Now, that's not true for things like age 59 and a half.
59 and a half is the day. Qualified charitable distribution, 70 and a half, the day.
That's still 70 and a half.
That's still 70 and a half. Even though they increased the required minimum distribution age to 72, they did not touch the qualified charitable distribution age. That one's to the day at 70 and a half. 72 is, the required minimum distribution is not the day you reach 72. It's the year you reach 72. There's no consistency in tax law.
Well, no, there isn't. And I know the last couple of weeks we've kind of talked a lot about taxes. But as I said, our discussion last week spurred questions from people this week about how do they use tax brackets to their advantage? How do you decide whether to do a Roth now? How do you decide when to do a Roth conversion? How does that help? These are important planning questions.
Roth conversions are, do I have room in my tax bracket? And is my tax bracket going to be equal to or higher in the future than it is today?
Well, and we talk about this because here's the thing. If you're going to work with a financial advisor, a financial advisor can't come to you and say, hey, you know what? I can make you an extra 10, 15% on your money. You go with me and I
can grow your money faster.
I can grow your money by 10 or 15% faster than anybody else. Don't listen to somebody like that. However, an advisor may be able to say, look, if you do things properly, I may be able to save you 10 or 15% potentially on taxes.
And you can use that to have fun or to save more.
Well, potentially, yeah, exactly. So what I'm saying is, by managing your taxes, Professor Plum, if you can pay less in taxes, is that in many ways the same as maybe earning more?
Well, I get to keep more.
Yeah, exactly.
So yeah, it's you're not earning more, but you get to keep more.
No, but
and
managing...
it all comes down to that. It's not what you earn; it's what you keep.
Yeah, exactly.
Yeah.
If I'm going to earn $1 million, but I'm going to lose 80% of it to taxes, then I haven't earned $1 million.
Yeah, if I take that big a risk, but
yeah,
it's a lot of it has to do with what's my bottom. And still, we're going back to also financial planning. It's not about making you the most money from a return standpoint. It's trying to lessen the risk, and it's trying to lessen the impact of expenses like taxation that can take away from the return.
Which is why you have a financial advisor, I think. That's not you don't have a financial advisor to get the greatest rate of return. If you are, then I think maybe you're going to be disappointed at some point.
Maybe, yeah.
I mean,
probably.
if you get greater rate of return, fine. That's nice.
Well, sometimes advisors have access to things that you've never heard of before that work for you.
Yes, but it doesn't mean that they're going to get you a 30% rate of return whenever everyone else is getting 7%. You just can't expect things like that. So this is why you hire financial advisors, I believe, to do things like manage your taxes, to look out for things like this. Am I correct?
Yeah.
Okay.
I had a call this morning from somebody who was saying, look at, we have a managed portfolio, we have a series of certified financial analysts, and he's looking, he goes, I would have never bought the things that are in my account. I'd never even heard of some of them. And he goes, but they've worked.
Well, yeah, and there's no guarantee that everything is going to work. I want to emphasize that. But by doing things like managing your taxes, controlling the things that you have control over, it can potentially be better for you.
It can be, yes. That's the bottom line.
You want to talk more about this with Professor Plum or any of the Lucia Capital Group advisors, I would suggest you do so. Manage your taxes. With the markets down like this, there may be some opportunities, as we said, some potential for Roth conversions, maybe, if it's suitable for you. There may be some things that you can do. Always a good idea to at least check. Talk to them, 800-644-1150, the number at Lucia Capital Group, 800-644-1150. Go online, find them there at luciacap.com. Lots of videos you can watch, interactive, well, not interactive, but instructive. As you say, you can't interact yet. Instructive articles and other blog posts, things like that, luciacap.com, luciacap.com. Spotify is where we are. Of course, you probably know that. If you're listening to this podcast, tell your friends and everybody to subscribe. You can subscribe and listen to this podcast every single week. A lot of great information, as we said. Next week, I'm hoping to have a guest on, Professor Plum.
Cool.
Not going to say who it is, but you and I, we've got a bigger studio now. We have room for one more, and we can maybe get a couple of other advisors. I want to get their point of view. I know we get your point of view, but I think it would be fun. No, I think it would be fun to have an advisor-type discussion. If I could pull this off, have an advisor-type discussion about things like what people are afraid of now. They're afraid of inflation. They're afraid of the markets. All of a sudden, they've turned fear, So how do you potentially allay those fears? I want to talk about that. So there may be a guest next week. Just got to work it out in the schedule. So Stay tuned for that. Thank you.
You're welcome.
Appreciate it. For Professor Rick Plum, certified financial planner, professional, I'm your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, or RMD, in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if
if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Rick Plum is a registered representative with and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.